Money Power Fraud presents Deepfake CEO Fraud. Chapter 1 Executive Exposure Synthetic Authority Failure. Over $400 million in capital has already been exposed, not through cyber intrusion, through synthetic authority. The system assumed identity was stable. It was not. Executive presence became reproducible. Voice, video, behavior, all simulated. Authorization protocols did not evolve. They remained trust-based, not verification-based. This created a structural mismatch. Advanced replication, primitive validation, and that gap widened quickly. Internal systems prioritize speed over confirmation, especially at the executive level. Requests appeared legitimate because they matched expected patterns, tone, language, urgency, all aligned. But authenticity was absent. This is where the failure begins. Authority was accepted without proof, and systems executed accordingly. Capital moved, controls passed, records validated the action. Everything appeared correct. It was not. This is not a breach scenario. It is a trust failure. No firewall was bypassed. No credentials were stolen. The system authorized the fraud internally because identity was assumed, not verified. This creates a new risk class, synthetic authority risk, where decision power can be replicated without access, without presence, only approximation. And that approximation is now sufficient to move capital at scale. This breakdown follows three phases: identity replication, authorization exploitation, institutional recognition failure. Each phase compounds the next until detection becomes irrelevant because execution has already occurred. Chapter 2 System Setup, Trust Anchored to Executive Identity. Corporate financial systems are built on hierarchical trust. Authority flows downward from executive level decisions. Approval structures prioritize speed, not friction, especially at the top. A CEO instruction is treated as final, not conditional. This reduces operational delay, but removes verification layers. Internal controls assume identity integrity. They do not test it. Authentication exists, but mostly at system entry points, not within decision pathways. Once inside the system, trust becomes implicit. Executive communication bypasses scrutiny because it is expected to. This creates a privileged channel where verification is reduced or removed entirely. Financial workflows are designed this way. Wire transfers, account changes, vendor redirection, all rely on authorization signals, not continuous validation. The assumption is simple. Executives are who they claim to be, and their instructions are legitimate. This assumption held historically because identity was difficult to replicate. Voice required presence. Video required physical access. Behavior was hard to mimic. That constraint is now gone. Identity has become data, and data can be reproduced at scale, yet the system has not adapted. Approval chains still rely on recognition, not verification. Familiar voice, familiar tone, familiar urgency. These are treated as proof. They are not. This is the core vulnerability. Trust is anchored to perception, not authentication, and perception can be engineered, especially under pressure. Time-sensitive requests amplify risk. Urgency suppresses skepticism. Executives often initiate high-value actions, quick decisions, and minimal delay. That pattern is predictable and exploitable. This is where the system becomes fragile. Not because controls are absent, because they are misaligned. They protect access, but not authority. And in financial systems, authority is the final control layer. Once it is compromised, everything downstream executes normally. Chapter 3 Expansion. AI enables scalable identity replication. Synthetic identity capabilities did not emerge gradually, they accelerated. Driven by model improvements and data availability, voice cloning reached operational accuracy, with minutes of input, not hours. Public interviews became training data, earnings calls, podcasts, keynotes, all usable. This reduced barrier to entry. Attackers no longer needed insider access, only open source material. Video synthesis followed the same curve. Static deepfakes became dynamic, then real time. Facial mapping improved, latency decreased, live interaction became possible, not just pre-recorded deception. This changed the threat model entirely because interaction builds trust, and trust drives execution. Email compromise also evolved. From spoofing domains to mimicking behavior, sentence structure, timing patterns, response cadence, all replicated. Communication became indistinguishable at the surface level. And surface is where most systems operate. Identity shifted from presence to pattern recognition. If it looked correct, it was accepted. If it sounded correct, it was trusted. This created a dangerous equivalence. Similarity became authenticity. and that assumption scaled risk. Attackers could now replicate multiple executives across multiple organizations simultaneously with minimal cost and near zero marginal effort. This is the inflection point. Fraud no longer required penetration, only simulation, and simulation is infinitely scalable, unlike access, unlike credentials. This is why the threat expanded rapidly, not because systems weakened, because replication strengthened, at a pace controls could not match, and this imbalance continues to widen. Chapter 4: Hidden Fragility, Authorization Without Verification. Most control frameworks were designed for a different threat model. They assume identity compromise, not identity fabrication. Access control is heavily enforced. Authentication is layered. Passwords, tokens, biometrics all protect system entry, but authority operates differently. Once identity is accepted, decisions are not revalidated, they are executed. This creates a separation. Access is secured and authority is assumed. And that assumption is rarely challenged, especially internally. Internal requests carry implicit trust. They are treated as low risk because they originate inside the system. But synthetic identity bypasses this logic, and it does not attack access, it exploits acceptance. The system does not ask, is this real? It asks, does this look correct? And that distinction matters because validation becomes superficial. Voice matches expectation. Instruction matches behavior. Urgency matches context. Everything aligns except authenticity. This is where fragility becomes visible. Controls are not failing randomly. They are operating as designed, but the design is outdated. Multi-factor authentication cannot solve this because the attack occurs after authentication within trusted communication channels. Email threads, voice calls, internal messaging systems. These are not monitored for authenticity, only for access legitimacy. This creates a blind spot, a critical one. Authorization becomes a single point of failure, and it is not independently verified, especially under executive pressure. High-value decisions often bypass friction to maintain operational speed, but speed reduces scrutiny. And scrutiny is the only defense here. This is the underlying flaw. Verification is optional, not enforced, and optional controls fail under pressure every time. Chapter 5: Mechanism. Breakdown: Deepfake CEO attack model. The attack model is structured, not random. It follows a repeatable sequence. Input begins with data aggregation. Public executive content is collected. Earnings calls, interviews, internal leaks when available, voice samples are extracted, cleaned, segmented, video frames are captured, expressions mapped, behavioral patterns are analyzed, speech cadence, decision language, response timing, and this creates a training data set sufficient for replication. Processing phase begins. AI models are fine-tuned on the target identity. Voice synthesis is calibrated for tone accuracy. Video models align facial movement with generated speech. Latency is reduced to enable real-time interaction. This is critical because delay breaks credibility. Execution phase follows. Target organization is selected, and typically finance teams and treasury departments, regional subsidiaries, the communication channel is chosen. Voice call, video conference, email reinforcement, often combined to increase legitimacy. Initial contact establishes context, reference to ongoing operations, known projects, expected transactions. This reduces suspicion. Then comes the directive: urgent, time-sensitive, confidential. Common instructions include wire transfer initiation, vendor payment update, account redirection. The language is precise, aligned with executive behavior, no anomalies. Authorization is implied, not requested. This is key. The instruction feels routine, but accelerated. The target executes because everything appears valid. Voice matches, face matches, context matches. No system flag is triggered because no system boundary is crossed. Funds are transferred to controlled accounts, often through layered entities, to obscure recovery pathways. Outcome is immediate. Capital leaves the system with full internal authorization. No breach, no exploit, only execution. This is why detection is delayed. Audit logs confirm legitimacy. Approvals are documented. Processes were followed. But authenticity was false, and that variable is not captured. Chapter 6: Trigger Events, High-Profile Deepfake Incidents. The model was not theoretical. It was validated in real transactions. With material financial loss, multiple incidents confirmed the same pattern across jurisdictions, across industries. One early case involved a European energy firm. A senior executive received a call from what appeared to be the CEO. The voice matched precisely. Tone, accent, cadence, all aligned. The instruction was clear. An urgent transfer was required. A supplier payment, time sensitive. The request fit expected behavior. It was executed. Funds were transferred. The voice was synthetic. No intrusion occurred. Another case escalated the model further. A multinational firm in Hong Kong conducted a video call. Multiple participants joined. All appeared legitimate. Senior executives, familiar faces. The interaction was live, not pre-recorded. Instructions were issued during the call. A series of transfers were authorized. Approximately $25 million was moved. The participants were synthetic, generated in real time. No one in the meeting was real, yet the environment felt authentic. Because context was preserved, this is the critical shift. Fraud moved from deception to simulation. The system was not tricked superficially. It was convinced structurally. Employees followed protocol. They verified what they could see and what they could hear. Both were accurate, but not real. No malware signatures were detected. No anomalous login patterns appeared. No alerts were triggered, because nothing broke. The system behaved normally. This is what defines the trigger phase. Proof of concept became proof of scale. Once successful, the model replicates rapidly across organizations because the requirements are minimal. Public data, AI tooling, process knowledge, that is sufficient. This marks the transition point from isolated fraud to systemic vulnerability. Chapter 7, Collapse Dynamics, Trust System Breakdown. Once the model is exploited, it does not slow. It accelerates. Replication cost approaches zero. No infrastructure constraint, no scaling friction. This changes the threat profile completely. Attackers no longer select targets carefully. They expand globally across industries, finance and manufacturing, healthcare and government. Any system with authority pathways becomes exposed. The attack surface is not technical, it is institutional, and it grows continuously because replication is cheap, near zero. What followed was rapid proliferation. Multiple organizations targeted simultaneously. Multiple executives replicated in parallel. No marginal cost increase. This is the inflection point. Fraud becomes industrialized, not isolated. Internal controls begin to fail, but not visibly, silently, because every action appears legitimate. Requests align with expected behavior. Tone matches, language matches, timing matches. Nothing appears abnormal. This is the critical failure condition. Controls validate appearance, not authenticity. Audit systems reinforce this. They confirm authorization. Approvals exist. Records are complete. Processes were followed. Exactly. But authenticity is never verified, only assumed. This creates a structural blind spot, a dangerous one. Post-event analysis becomes unclear, not because data is missing, because data confirms the fraud. Every log supports execution. Every approval appears valid. There is no contradiction, only false certainty. This creates post-event ambiguity, not prevention. Investigation becomes interpretation, not detection, because the system lacks a reference point. To distinguish real from synthetic, this is the core breakdown. Identity signals are no longer reliable, but systems still depend on them. Completely. The system cannot distinguish real from synthetic, because both follow the same patterns, the same structure, the same authority pathways. This is where collapse occurs, not at the perimeter, within execution, where trust converts into action, without verification. And once that happens, the system does not resist, it complies. Chapter 8, Institutional Failure, Control Systems Lag Reality. Corporate governance frameworks assume identity stability. They were designed for static verification, not dynamic simulation. Policies focus on access control, not authority validation. Compliance frameworks enforce procedure, not authenticity. Audit systems confirm approvals, not origin integrity. This creates a structural delay. Threat evolution is exponential. Control adaptation is linear. Most organizations update defenses after loss, not before exposure. Training programs reinforce outdated threats, phishing awareness or credential security, but not synthetic identity. Executive impersonation remains undermodeled, despite growing evidence. Regulatory bodies face the same constraint. Guidance is retrospective, based on known incidents, not emerging capabilities. This creates systemic lag. By the time controls are recommended, the threat has already evolved. Board-level awareness is inconsistent. AI risk is discussed broadly, but not operationalized. Few organizations map identity risk across decision pathways. Even fewer redesign approval systems to account for simulation. This is the institutional gap. Recognition without restructuring, awareness without enforcement. The system acknowledges the risk, but continues operating unchanged. This is where failure compounds, because partial awareness creates false confidence. Controls appear sufficient, they are not. Until a triggering event occurs, Then response becomes reactive, not preventative, and the cycle repeats. Chapter 9: AI and Synthetic Finance Convergence. This is not an isolated fraud vector. It is a structural convergence. AI is integrating into financial systems. At the same time, it is destabilizing them. Synthetic identity is becoming a functional tool, not just an attack method, and it can simulate participants in transactions, in negotiations, in approvals. This changes how financial interactions occur because presence is no longer required, only representation, and representation can be engineered at scale. This introduces a new category: synthetic participants in financial systems, entities that appear legitimate but have no physical counterpart. This enables multiple exploitation pathways: fraud execution, market signaling manipulation, executive level deception, even internal process disruption, all driven by simulation. The system cannot easily distinguish actors because validation relies on perception, not cryptographic certainty. This blurs a critical boundary: real versus synthetic, and finance depends on that boundary, especially in high-trust environments, where speed overrides scrutiny. This is the convergence point. AI enhances system efficiency, but also amplifies system vulnerability. The same capability enables both. Automation increases throughput, but reduces human verification, and reduced verification increases exposure. This creates a reinforcing loop: more AI integration, more reliance on automated trust signals, more opportunity for synthetic exploitation. This is not a temporary phase, it is a structural shift. Financial systems are becoming partially synthetic, whether recognized or not, and that changes risk permanently. Chapter 10: Operator Risk, where exposure exists today. Exposure is not evenly distributed. It concentrates in specific operating environments. First, high-velocity payment systems. Treasury functions processing large transfers. Under tight timelines, speed reduces verification. Second, decentralized approval structures. Multiple regions, distributed authority, inconsistent controls. Third, remote executive communication. Voice and video replace physical presence. Identity becomes signal-based, not physical. Fourth, frequent exception handling. Non-standard transactions, urgent approvals, these bypass normal controls. Fifth, weak secondary verification, single channel confirmation, email only, call only, no independent validation layer. This is critical because synthetic attacks dominate a single channel, not multiple. Sixth, predictable operational windows, quarter-end pressure, after-hours execution, reduced staffing, higher urgency, lower scrutiny. Seventh, culturally enforced compliance, that teams trained to execute, not challenge authority, especially from senior leadership. This suppresses resistance, even when signals feel inconsistent. These environments share one characteristic: authority is assumed, not continuously validated. That assumption creates exposure. If identity is not independently verified, execution becomes the vulnerability, not the system. Operators often believe risk is external: firewall, access control. It is not. It is internal, within decision pathways where authority converts into action without resistance. This is where exposure exists today. Chapter 11: Strategic Defense, Rebuilding Verification Systems. Defense cannot rely on detection alone. It must redesign execution pathways. First principle: separate identity from authority. Identity signals are no longer sufficient. Authority must require independent validation. Every high-value transaction needs dual-channel confirmation, not email and reply. Independent channels: voice plus secure system approval, or system plus in-person verification. Second principle: introduce controlled friction. Speed is the vulnerability. Deliberate delay reduces exploitation. Even minutes matter for anomaly recognition. Third, enforce multi-party authorization, not hierarchical approval alone. Parallel validation from independent actors who verify separately. Fourth, implement behavioral anomaly detection, not just credential monitoring. Flag deviations in instruction timing, language patterns, transaction sequencing. These signals reveal synthetic interaction. Fifth, restrict executive override pathways. Emergency authority must be constrained and logged with enhanced verification, not assumed as legitimate. Sixth, redesign communication protocols. High-risk instructions must originate from secured systems, not open channels. Email and voice become secondary, not primary. Seventh, train for synthetic threat recognition. Not phishing, not malware, but identity simulation. Teams must expect impersonation, not assume authenticity. This changes behavior, from compliance to verification. Eighth, simulate attacks internally. Test response pathways, measure failure points, refine controls continuously. Defense must evolve with capability, not lag behind it. This is not a technical fix. It is a structural redesign of how decisions are validated, because the system failed at validation, not execution, and without redesign, it will fail again. Chapter 12, Final Interpretation, Authority as an Attack Surface. The failure was not technological, it was architectural. Authority was treated as proof instead of a signal. That assumption no longer holds. Identity can now be replicated with precision, with scale, and without access. This changes the system fundamentally, because financial execution depends on trust, not just logic. When trust becomes programmable, it becomes exploitable continuously. This is the core shift. Fraud no longer targets systems, it targets decisions. And decisions rely on perceived authority, not verified authenticity. That is the vulnerability. Organizations that adapt will redefine verification beyond recognition toward provable validation. Those that do not will operate under false certainty. Controls will appear intact, while risk accumulates beneath them. This is not a temporary threat cycle. It is a permanent condition. Synthetic identity will not recede. It will improve faster than governance frameworks evolve, which means exposure will persist and expand. The implication is direct. If authority can be simulated, then it cannot be trusted by default. It must be proven every time, or the system will continue to authorize failure.